In 2021, a literal joke, cryptocurrency like, an asset with a picture of a dog on it, minted these overnight millionaire.
Oh, yeah. Totally wild.
Right. And meanwhile, supposedly safe, long-term government bonds lost billions of dollars in real purchasing power.
Exactly. It's a massive contrast.
And we all see the headlines, right? Like you see that and you want the soaring lottery ticket profits. But I mean, we are absolutely terrified of the crushing, life-altering crash that could come with it.
Yeah, nobody wants to get wiped out.
Right. So what is the actual underlying physics behind who gets rich and who gets just, well, entirely wiped out?
I mean, it's the dynamic that dictates every single move in the global economy. Yet from the outside, the way those winners and losers are sorted feels completely opaque.
Oh, 100%.
It just feels like a casino sometimes.
Which is exactly why today we are doing a custom deep dive just for you. We are pulling apart this very concise, but honestly incredibly foundational piece of source material.
Yeah, it's a great little file.
It really is. It's a short audio-video piece titled Understanding Risk and Returns.mp4. Now, it's a really quick hit. It actually ends with this rapid-fire call to subscribe for more tips.
Right. Very YouTube style.
Exactly. But the mission for our deep dive today is to extract the absolute core mechanics of investing from this source. Because, look, we know our audience. We all know the textbook definitions, right?
Sure. Risk is your chance of losing money, and return is your profit. Basic stuff.
Right, but what this source isolates so effectively isn't the definition. It's the inextricably linked physics between the two.
Yeah, in a world where, everyone is just shouting about the next hot stock.
Oh, or the next massive crypto coin.
Exactly. Understanding the mechanics of why those assets move the way they do is literally your only real defense against making those panicked, emotionally driven decisions.
Okay, let's unpack this. Because usually, people talk about risk and return like driving a car. You know the cliche.
The speed analogy, right?
Yeah, exactly. Like returns are how fast you drive to your destination, and risk is the chance of getting into a horrific crash along the way. So you try to drive fast while actively avoiding the crash.
Makes sense on the surface.
Right. But looking at our source material, that analogy actually feels fundamentally flawed to me.
How so? I mean, the car metaphor is pretty standard in personal finance.
It is, but in finance, the crash-like, the actual risk, isn't an accident you're just hoping to swerve around. The risk is actually the source of the profit.
Oh, interesting.
Yeah, it's a mathematically priced-in certainty over time. To me, it feels much more like running an insurance company.
Okay, wait, walk me through the mechanics of that.
Mhm.
How is it like insurance?
So think about how an insurance company makes money. They only collect a premium, which is their profit, because they are voluntarily taking on the financial risk of someone else's disaster.
Ah, I see where you're going.
Right, like if houses never caught on fire or if hurricanes never hit the coast, no one would ever pay them a dime.
Right, there'd be no market for it.
Exactly. The danger itself is the product. So when we look at financial markets, the return you get isn't you successfully avoiding risk. The return is your compensation for explicitly taking it on.
Wow, yeah. What's fascinating here is that the market doesn't pay you for being lucky. It literally pays you for bearing uncertainty.
Yes.
If you look at the source material, it emphasizes that higher risk investments often promise higher returns, but they inherently bring a higher chance of loss. The universal trade-off.
Right.
The profit is literally the premium you are paid for, enduring the possibility of being wiped out.
Wait, so if the wild fluctuations of an asset aren't a bug-like, are you saying the market actually prices an asset cheaper because people are terrified of its volatility?
That is the exact mechanism at play, yeah.
Yeah.
Let's say there's a new technology company, right?
Yeah.
And nobody knows if they're going to revolutionize the world or go bankrupt in 6 months.
Right, super risky.
That uncertainty terrifies the average person. So the only way investors will buy that stock is if the current price is driven down so low that the potential upside, if they actually succeed, is massive.
Oh, wow. So the fear creates the discount.
Exactly. And that discount represents your potential return.
So the market is basically demanding a massive potential upside to even consider taking the ride. Like the return is the bait to get you to swallow the risk.
Precisely. And if that uncertainty is removed, say the company signs a massive guaranteed 10-year government contract, the risk just plummets.
Because the cash flow is locked in.
Right. But instantly, the price of the stock shoots up, meaning anyone buying it now gets a much lower future return. The risk and the return balance out in real time.
That is wild. And that structural reality grounds the next major concept in our source, which maps out the actual investment spectrum.
Yeah, the source does a good job of laying that out.
It really does. We're moving from the theory of the risk premium to where you can actually, park your cash. The source sets up two distinct ends of the spectrum.
The safe stuff and the crazy stuff.
Right. Government bonds and savings accounts on the low-risk end versus stocks and cryptocurrencies on the high-risk end.
Which is a perfect place to examine the underlying mechanics of how these instruments actually work.
Totally.
Because, frankly, a lot of people see a bond and a stock simply as a safe thing to buy versus a dangerous thing to buy, without really understanding the legal and mathematical architecture behind them.
Let's break that architecture down, though, because the source points to government bonds offering a small, steady return with minimal risk. Mechanically speaking, what actually makes it minimal risk?
Well, a bond is essentially a legally binding IOU.
Okay.
When you buy a bond, you are lending your money to an entity like the federal government or a large corporation. In exchange, they are legally, contractually obligated to pay you a specific interest rate over a specific period of time.
Right, and then they return your original money at the end.
Exactly.
So your risk is mathematically capped by that contract, assuming, I guess, the government doesn't entirely collapse.
Right, which is a pretty safe bet.
Yeah.
And because you have a legal guarantee to be paid back, you have absolute priority in the event of a bankruptcy. Debt holders get paid first.
Oh, I didn't realize that.
Yeah, that legal protection drastically lowers the uncertainty. And, following the physics we just established, because your uncertainty is low, your required return, your profit, is correspondingly small.
Right. You aren't bearing much of a burden, so you don't get paid a large premium.
Exactly.
Whereas a stock is mechanically entirely different. When the source talks about stocks and crypto fluctuating wildly with the potential for greater returns, it's because you aren't lending money anymore.
Right. You aren't a lender.
You are buying an equity stake.
Yeah, you are buying a tiny slice of the business itself.
And there is zero legal guarantee of a return on a stock. Like, if the company makes a ton of profit, the sky is the limit, infinite upside.
Yep.
But if the company fails as an equity holder, you are at the very bottom of the capital structure. You get paid last.
Which usually means you get nothing. Just a total loss. And crypto takes this even further. With many cryptocurrencies, there isn't even an underlying business generating cash flow.
It's just lines of code.
Pretty much. It is pure speculative price discovery based on supply, demand, and network adoption. It is the absolute far end of the uncertainty spectrum.
Here's where it gets really interesting, though. Hearing all of this, the architecture makes logical sense, but I want to push back on the framing for a second.
Okay, let's hear it.
Let's look at that savings account or that baseline government bond. The source says it offers a small, steady return. But if that return is, say, 2%, and inflation is running at 3%.
Oh, I see where you're going.
Right. Is a savings account really a risk-free investment, or is it mathematically guaranteeing that your purchasing power is slowly bleeding out over time?
If we connect this to the bigger picture, you are identifying the invisible risk.
Yes.
In the short term, the savings account feels perfectly safe because the nominal dollar amount never goes down. You put in $100, you still have $100.
You check the app, it's still there.
Exactly. There's zero volatility. But you're right. In the long term, the lack of growth means the silent tax of inflation is absolutely eroding your wealth.
It feels like human nature just makes us hyper-focus on the immediate visible pothole, like a stock dropping 10% in a day.
Yeah, everyone panics.
So we completely ignore the slow, invisible leak in the tire.
Which is exactly why the source emphasizes that blindly chasing safety or blindly chasing growth is the wrong approach. It actually pivots away from the external mechanics of the assets and focuses entirely on the internal mechanics of the investor.
Right, the human element. According to the source, the ultimate key to success isn't just knowing the structural difference between a legal bond contract and an equity stake. It's understanding your own personal risk tolerance.
That's the real secret.
Yeah. The source specifically states that this self-awareness helps you choose investments that align with your comfort level.
And this is where the math basically collides with biology. We can sit here all day and rationally explain that a high-risk premium demands wild volatility. But knowing that intellectually doesn't change how your body physically reacts when half of your net worth evaporates on a random Tuesday afternoon.
So what does this all mean for you, the listener? When I hear the term comfort level used in this financial context, my brain immediately translates that to the sleep test.
The sleep test, yeah.
I love that because I really believe that risk tolerance isn't a spreadsheet calculation. It is a deeply emotional, psychological limit.
The sleep test is a great heuristic. Let's actually explore why so many people fail it, even when they think they understand the math.
Well, imagine you take a significant chunk of your savings,
Right.
and you buy into a volatile asset, maybe a tech stock or a cryptocurrency. You're chasing those high returns we talked about.
Right, you want the big payoff.
The asset begins doing exactly what the source and the structural mechanics dictated it would do. It fluctuates, it goes up 15% one rip, and you feel like an absolute genius.
Oh, you're on top of the world.
But then, the next week, the market spooks and it drops 30%.
And at that moment, the theory of the risk premium is no longer theoretical.
Exactly. If you find yourself waking up at 3 a.m. in a cold sweat, immediately reaching for your phone in the dark to check your portfolio app just to see if you've lost your life savings.
Yeah, we've all been there.
Right. Your body is physically rejecting the math. You have failed the sleep test.
And what's crucial here is understanding why our brains react so violently to that drop. It's a really well-documented behavioral mechanism called loss aversion.
Okay, tell me about that.
So psychologically, humans process the pain of losing money about twice as intensely as the joy of making that exact same amount.
Wow, twice as intense.
Yeah, a $10,000 gain makes you smile, sure, but a $10,000 loss makes you physically ill.
So even if the long-term trend of the asset is upward, that day-to-day whiplash just breaks your psychology.
Yes, and when your psychology breaks, you make behavioral mistakes.
You panic sell.
You panic sell at the absolute bottom. I mean, the volatility was supposed to be the feature you endured to earn the premium. But because you exceeded your personal comfort level, you tapped out. You sold the asset at a massive discount, locking in a permanent, realized loss just to make the anxiety stop.
It's incredible when you frame it that way. Panic selling literally turns a temporary mathematical fluctuation into a permanent destruction of your wealth.
Exactly.
And that loops perfectly into the summary the source provides. The source tells us to balance your comfort with potential rewards for better results, but we really need to define what better results actually means in practice.
This raises an important question because the instinct is to just assume better results means the maximum possible dollar amount on a spreadsheet.
Right. Like if you run a simulation of the last 50 years, putting 100% of your money into the most aggressive stocks will almost always yield the highest theoretical return.
Sure, on paper.
So mathematically, that's the best result.
But the source's framing implies something much deeper. Synthesizing the mechanics we've discussed today, better results does not equal the highest theoretical yield. Better results means successfully harmonizing your portfolio with your psychological breaking point. It means building an investment strategy that you can actually stick with through the darkest, most terrifying market crashes.
Consistency over chaos.
Exactly.
The optimal portfolio isn't the one that makes the most money in a vacuum. It's the one that prevents you from hitting that self-destruct button at 3 a.m.
Think about the person who accurately assesses their risk tolerance and chooses a more moderate investment.
Yeah.
Maybe they blend those legally bound, low volatility government bonds with a smaller portion of high growth stocks. When the market inevitably tanks by 30%, their portfolio might only drop by 10%.
It hurts, but it doesn't break the sleep test.
Exactly. They don't panic. They stay invested while the market recovers. And over 20 years, they achieve a massive, steadily compounding return.
While the other guy's just out of the game.
Right. Meanwhile, the person who chased the maximum theoretical yield panicked during year 2, sold everything at a loss, and just never got back in. The moderate approach achieved the objectively better result because it was behaviorally compliant.
It's so profound when you peel back the layers like that. The most complex, mathematically perfect investment strategy in the world is completely useless if you don't have the emotional endurance to see it through.
And that requires a brutal level of honesty with yourself.
Okay.
You really have to admit what your psychological limits are.
Yeah.
You can't look at what your neighbor is doing or, what some influencer on social media is bragging about. They might have a completely different time horizon, a different income level, or just a fundamentally broken sense of risk.
So true.
Their risk tolerance has absolutely no bearing on your reality.
Which brings us full circle to the very first question we asked at the top of this deep dive. Why do some investments soar while others completely wipe people out?
It's not a mystery.
Right. As we've extracted from our source today, the secret isn't luck, and it certainly isn't magic. It is the strict, unyielding mechanism of risk versus return.
The market is incredibly efficient at pricing uncertainty.
Yeah, if an investment offers a massive potential payoff, it is structurally demanding that you endure the very real possibility of losing it all. The profit is literally the payment for your anxiety.
Well said.
And on the flip side, lower risk brings the small, steady return because you are demanding the safety of legal contracts and priority payouts. The entire mechanism is totally transparent once you stop looking at it like a casino and start looking at it like an insurance model.
It's just a series of deliberate trade-offs. You are choosing which kind of discomfort you want to live with.
And the real revelation here is that you protect yourself from the wild crashes like the ones that truly devastate people's lives by deeply understanding your own emotional limits. By balancing your psychology with the math, you prevent yourself from taking on a level of volatility you just aren't prepared to survive. It's the ultimate self-defense.
It forces you to realize that you aren't just managing money. You are managing your own behavior.
You really are. So as we wrap up our analysis of this core financial source, we want you to take a hard look at your own portfolio.
Yeah, do the gut check.
Run your own sleep test tonight before you make your next move. Assess your comfort level and ask yourself if your money is currently behaving in a way your nervous system can actually handle.
But before we sign off, I want to leave you with one final thought to mull over. Something that builds directly on the structural framework our source just laid out.
All right, what is it?
We've established that minimal risk, like a cash savings account, mathematically equals a small, steady return. That is your baseline of safety.
Right.
But think about the actual trajectory of your life. Think about the destination you are trying to reach, whether that's retiring with dignity, buying a home, or ensuring your family is taken care of decades from now. If you play it entirely, 100% safe to protect your short-term comfort, and those tiny returns simply do not outpace the invisible erosion of inflation, does avoiding all market risk eventually become its own catastrophic kind of long-term risk?
Oof, a completely different kind of danger to keep you awake at night. Think about that the next time you decide to play it safe.